Okay, we're going to go ahead and get started. Thanks everyone for joining today. Really appreciate you taking some time out of your day to come meet with us. And I hope you're having a good week. It's a little overcast here in Charlotte, North Carolina, but we're still happy to be together. I'm especially happy. I think it's going to be a very productive spring now that three things are behind us. Spring break is over. I hope you went somewhere warm and got a little R&R with your family. Number two, March Madness is behind us. Congrats to UConn and South Carolina. If we have any alums, congrats. I know productivity in my office really goes way down during March Madness, as it does in many others. So that's behind us. And now officially, Eclipse-mania is over. It was really, really awesome. I hope everybody got a chance to see it. I actually had some family traveling from Washington, D.C. to Pennsylvania in order to be in totality. So really, really cool experience. Got some great videos, got some great pictures, but all these things are behind us now and we can get down to work. So let's go ahead and jump in for today. I'm going to go ahead and share my screen. For those of you that don't know me, my name is Benjamin Dolan, and I'm the owner of Dolan Capital Advisors. And we're a financial planning and investment management firm here in Charlotte with the mission of simplifying finances and reducing stress for our physician clients. We manage about 120 million in assets, and we have a fiduciary relationship with our clients at all times. We think that's really important. We're also fee only, which means our only source of compensation comes from our clients. Also very, very important. If you want to find out more about our firm, you can visit us at dolanca.com. Again, dolanca.com. And the genesis for these webinars really came from conversations with our current clients. They wanted to have more information about certain financial planning topics, and we were happy to put those together. And those sort of delved into a webinar series that we're doing now. So if you were not able to join us for our last webinar, it was on retirement planning for Atrium physicians. Next month, we're going to do one on estate planning for physicians. So I hope you can join us. But today is really all about student loans. Certainly a very, very hot topic. Front page of the Wall Street Journal today, current administration is thinking about more student loan forgiveness. So we're very happy to have Joe McGrath from GradFin with us today to talk about everything student loan related. So Joe presents to financial advisors from coast to coast about the value of meeting with a student loan consultant to help them navigate the perfect repayment plan. In addition to his current role in sales and client management, he has experience in both the recruiting and nonprofit industries. Joe currently lives in Philadelphia and is a graduate of Temple University's Fox School of Business with a BBA in marketing. So very, very happy to have Joe with us today. Joe, thanks for joining. Again, apologies on our end, having some trouble with video, but we know his audio is working and he'll be able to share his presentation today. So Joe, I'll turn it over to you.
Thank you, Ben, and appreciate everyone listening into the presentation this afternoon. I'm going to share my screen here. So yeah, everyone, my name is Joseph McGrath. I'm a manager of business development over here at GradFin, and my goal this afternoon is to bring everyone up to speed with what's going on in the landscape of student loans. That pertains to kind of what Ben mentioned before, some of the current events, the changes in the student loan landscape, which seems to be ever changing. Every single day, we seem to have new headlines out there about potential forgiveness options and changes to repayment strategies, repayment options that are available on the federal side of things. We're going to cover all that. Also want to cover some popular repayment plans for physicians. Big talking point of what we're going to cover this afternoon is actually public service loan forgiveness, because there's a lot of misinformation about that program, and I want to clarify basically what it means and how to get enrolled in it, and then of course how GradFin can help with it as well. But just to get started here, let's go very high level and talk about GradFin as a whole. So our mission overall is to help student loan borrowers manage their student debt and start saving for the future. And to quickly get through with the commercial here, GradFin provides free access to a dedicated team of student loan experts for 30-minute consultations and then one call will help you make an informed repayment decision. Like I mentioned before, Joseph McGrath. I manage the business development team over here at GradFin, resident of Philadelphia. I've been here for about 13 years now, since I started going to Temple University way back when. And I haven't left the city since, but I'm originally from Scranton, PA, if you have any Office fans out there. So yeah, let's get rolling with the info here. So let's start very high level. I promise it's not going to be this general. We're going to get a little bit more zeroed in as we go. But I always like to start with this slide, because a lot of the common misconceptions in student loan repayment really start at the genesis of federal versus private loans. So basically, there are two types of student loans out there. And if anyone tells you otherwise, they're not telling you the truth. But there's federal student loans, which are owned by the federal government, fairly straightforward. And now you can have loans that are managed by different servicers, but they still will always be owned by the federal government if they are a federal student loan. Then there are private loans. These are non-federal loans, obviously, and they are originated through banks, credit unions, state agencies, or sometimes even the schools/universities themselves. So just to get a little bit more in depth there, for loan type, federal government originates those. Private banks and financial institutions originate those. But interest rates are dictated on the federal side. Typically, they're fixed and used a weighted average for consolidation. And then for private loans, they are fixed or variable based on underwriting. Underwriting is your income, your credit score, how you file your taxes, your savings. All that's taken into consideration when a bank will give you a loan. That will determine what your interest rate will be. Now, consolidation is one big thing that I do want to talk about very, very quickly. There is a huge misconception out there among the general public on consolidation versus refinancing. A lot of people think they're interchangeable, when in actuality they could not be more, well, I should about to say could not be more different. They are similar, but they have massive implications in terms of your payment options. Consolidation means you are combining many student loans into one, or combining a few student loans into one. Whereas refinancing, you're shifting loans from one servicer to another. Now, you can consolidate loans during a refinancing, but when thinking about refinancing versus consolidation, think consolidation means combine, same first two letters there. Refinancing means you're shifting them from one servicer to another. Typically, that means you're going from a federal to a private loan. That leads me into refinancing. Can you refinance a federal student loan and keep it federal? No, you cannot. You can only consolidate federal student loans. But you can refinance a federal loan into a private loan, or refinance existing private loans. And then finally, loan forgiveness / IDR repayment, which is a huge talking point that we're going to cover over this presentation. Can you get forgiveness on a federal student loan? Yes. For a private loan, no. And I'll cover what that means in more detail as we go. So let's talk a little bit about the student loan landscape. Kind of like what Ben mentioned before, there has been an update this week in terms of a potential new forgiveness option, which is looking like, from what I've read, going to be very similar to the forgiveness proposal they rolled out in the summer of 2022. But we know where that ended up. So basically, if you remember back in I believe it was August of 2022, the Biden administration proposed a new student loan forgiveness plan, which was just anywhere from 10 to 20,000 taken off the balance as a federal student loan borrower, so long as you're below a certain income threshold. If memory serves, you had to be below $120,000 personal income, or if you're married and filed jointly with a spouse, it was $225,000. I could be wrong there a little bit on the numbers, but long story short, that proposal went all the way up to the Supreme Court in less than one calendar year. And on June 30th, 2023, it was rejected in the Supreme Court. That came on the heels of the expiration of federal student loan repayment freeze, which had been ongoing since March 2020. So if you remember way back when the pandemic started, one of the first rollouts that the former presidential administration had was called the CARES Act. And part of that CARES Act was a suspension of interest and payments on federal student loans. That was initially just a 6-month freeze. It was set to wrap up in September of 2020. But as we know, the goalposts kept getting shifted on that. They kicked it 6 more months, then an entire year. And then we had an election. One administration transitioned to another administration. They had different viewpoints on what sweeping student loan forgiveness would be. All that led to that getting pushed up into the summer of last year, when they announced that federal student loans would be resuming. And then on September of 2023, student loans turned back on, with October of 2023 being when federal student loans were owed for the first time since March 2020. Some of the fallout of that also, there was a one-time adjustment for income-driven repayment that actually expires at the end of this month. I won't get too into detail there because I'm going to cover it in a later slide, but If you heard about the one-time adjustment, it basically just means you're going to be able to retroactively get payments back that would get you closer to a student loan forgiveness down the road. Like I mentioned, that's going to expire at the end of this month, but there is talks that it's going to be signed into law or extended again. So again, I'll cover that in later detail as we go. But the big one is the new SAVE program. So basically, the Biden administration, when the rejection of the sweeping student loan forgiveness came out, they put together the SAVE program. What the SAVE program is, the new version of income-driven repayment that they want to be the standard general repayment option for all federal student loan borrowers in the coming years. And they're constantly changing it, tweaking certain things to make it kind of the one-size-fits-all, all things student loan repayment. So let's cover that in a little bit more detail. Okay, I know big scary slide here with lots of words, a lot of confusing stuff. Don't worry, I'm going to make it as palatable as possible. The good news is every slide after this gets significantly easier to understand. But I want to go high level here just so because it kind of gives us the groundwork for where we're going to go throughout the rest of the presentation. So income-driven repayment is a repayment option that takes into consideration how much money you make, how you file your taxes, other debt that you have, and calculates quote unquote affordable monthly payment that will promise the borrower some type of forgiveness down the road. So basically, there are 4 different versions of IDR. I won't go through each and every one of them. The main thing we want to focus on is the SAVE program, which I will give some background on as we go. But just keep in mind, these programs are far and away the most complicated thing in the entire student loan landscape. I always make the joke that, if you ask me to sit down, I've been working in this field for 7 years. If you ask me to sit down and write all the differences between these programs and how they calculate monthly payments, there are such subtle things that make massive changes down the road that I probably wouldn't be able to get 100%. But that's why we have an in-house tech at GradFin where we help you calculate what the right version would be and actually forecast how your payment's going to change over the course of the repayment period. But keep in mind, all of these programs are typically taken off the basis of a borrower committing to 10% of their after-tax income year over year going towards their student loan. So that's basically, there are certain different calculations that go into these, but the very general overview is typically it's a borrower saying, I'm going to use 10% of my income every year after taxes to pay my student loans. And that's going to be paid over the course of 20 years. And at the end of the 20 years, the remaining balance on your loans is forgiven. There is a catch with income-driven repayment where everything that's forgiven at the end of the 20 years is considered taxable income. But over here at GradFin, we have a workaround there, which I'll cover as we, later on. But that's something to consider. But really what it is, it's a repayment program that's targeted towards your middle income borrowers, whereas public service loan forgiveness, which I'll cover in the next slide, is a lot more far reaching. So the SAVE program, if you heard about it, in short, just to kind of give you the baseline overview, it's the lowest amount required out of all the different IDR programs that you're committing to your student loans. It's 5% of your undergraduate loans instead of the 10%, which it is for everyone else. It also excludes spouse's income. A lot of the catches with these programs is if you're married and filed jointly, your 10% of your after-tax income that you pay towards your student loans is taken off both yours and your spouse's. That's one of those things. That's a huge difference as opposed to just doing your personal income. And then in addition to that, there's an interest benefit. If your monthly payment doesn't cover the accrued interest, and what that means is if the interest ever month over month ever grows higher than your required monthly payment, in a lot of situations you see people with federal student loans where that is the case, and they see their balance increase and increase, and they're never actually paying it off. For the SAVE program, it's actually different. If it ever is greater than the monthly payment, the loan balance will not grow. It's just going to sit stagnant, and you're just going to pay what you need to pay until you get that forgiveness at the end of the 20 years or so. So that's IDR. Again, I know that's confusing. It gets a lot simpler from here on out, but keep in mind, what part of what we do over here at GradFin is if income-driven repayment makes sense for someone, we're going to help them find the right version of that and make sure they're up to date with everything and they're in the one that's going to save them the most money at the end of the day. But let's talk about public service loan forgiveness. Now, this is probably the most important part of the puzzle if you have public service loan forgiveness available to you, or if you've been curious about it. Even if you Googled it, I'm sure people have heard the horror stories about people getting rejected. My goal here is not to scare anyone, is to provide clarity on why some of these issues come up. So basically, public service loan forgiveness was created in 2007 under the Bush administration. And what it was a response by the public saying, either it was people in the medical field saying, I'm making good money, but I'm just like burdened by this debt. I'm seeing six-figure balances. I'm never paying it down. I don't know what to do. Or inversely, there was a lot of people, think about public school teachers who think, I'm working in the public school system. I'm providing a service for the government, for society as a whole. I'm not making that much money. My balances aren't crazy, but I'm never going to pay this off. So the Bush administration put together this program, and it used the skeleton of income-driven repayment, but made it in sort of optimum form. So basically, how your monthly payments are calculated under public service loan forgiveness is the same as IDR. In fact, you choose one of the 4 IDR programs in order to enroll in for PSLF, but there is a huge difference here. One is, instead of 20 years, it's 10 years. So that's already half the amount of time that you would pay if you were just in standard income-driven repayment. In addition to that, everything that's forgiven for public service loan forgiveness is forgiven tax-free. So they're just wiped off your record completely, and you don't need to worry about it. How are you eligible for this program? A couple different ways. The main thing is your employment. If you're working for a 501c3, a nonprofit, public health system, that means a public hospital, law enforcement, military, public schools, government positions, they all have public service loan forgiveness available to them. You need to work full-time. That is equal to 30 hours a week. If we have anyone who's practicing or even in residency, especially residency, I should say, you're probably working way over that, and you can actually get into IDR and public service loan forgiveness sooner. And then finally, you need to have direct federal loans and be in an income-driven repayment plan, like I mentioned, or a standard 10-year repayment plan, but that's going to end up making you pay a lot more. If loans are not direct loans, the borrower must consolidate them before April 30th, 2024 to be eligible for the one-time adjustment and forgiveness. That date is still set in stone to be the date that the one-time adjustment is going to expire. We've heard rumblings that it's going to be extended, but nothing's promised until it's promised. So if you think you apply for that, certainly be proactive, reach out to Ben. He can get you connected with someone on the GradFin team. And then finally, the thing that I want to not scare anyone with, but give clarity, is the rejection rate. So I'm sure if you've Googled public service loan forgiveness in the past, you've heard about, people getting rejected. And that's the truth, because the percentage is correct that 96% of people who go through this program without any sort of assistance whatsoever, they think, oh, I have it handled, I'm just going to get forgiveness after 10 years. 96% of people are rejected from this program. 96% of people go through the 10 years thinking they have everything in line and are rejected outright for the forgiveness. Why is that the case? Well, I would say 90 to 95% of the time it's through no fault of the borrower themselves. This program is very difficult to navigate. There's a lot of paperwork, and the big thing is the service is not incredible. If you try to call the Department of Education to get some clarity on what's going on, you're going to be put on a 2-hour hold. If you do get in contact with someone, it's a lot of paperwork you need to pull up, a lot of referencing you need to get to, and it's a complex process. The rules are highly complex and require a lot of annual paperwork for income and employment. And if there's changes in your income, changes in your employment, you go from one service or to another, you go from one hospital system to another, or you might think about starting a private practice, which would knock you out of eligibility. They might not tell you that. There's so many different things that can pop up along the way. That's why we have membership programs in place to help people stay in compliance with the rules and regulations of these programs. I say it's like insurance, that you're doing everything correctly. A lot of people don't like that term, but I think it's the easiest way to describe it. Basically, if a borrower forecasts a forgiveness event during a consultation, that means when we have this conversation with them, we're covering all the bases. I don't want to bury the lead here. I'll cover it in a little bit more detail as we go. And don't worry, we are getting towards the end. Basically, what we do on these calls is we get a look at the client's situation from a 40,000-foot view, and what they're doing for work, their goals, their saving strategies, whatever it is. That's all taken into consideration, helps determine, okay, maybe you should enroll in IDR. Maybe you should enroll in public service loan forgiveness. And then from there on out, we're going to provide a detailed report to the borrower, assist them in choosing the correct IDR plan for both PSLF or standard IDR, audit past payments to verify they count as qualified payments. That means we're going to take a look at all your payments up to that date to make sure everything counts, certified, and ready to go. We have appeals processes in place with the Department of Education if payments are not properly counted. We provide an estimate on the saving for the tax liability for IDR. Like I mentioned before, if you go through IDR itself, there's a tax hit at the end. Year over year, we let you know how much money you should set aside for that eventual tax hit. That's where Ben and his team step in. They can say, hey, you can use a money market account, high yield savings, whatever direction I want to point you in there. That way, you're having your money working for you, and you're going to be prepared for that tax hit down the road. We do charge for this program. It's an annual fee of $249, but you would not pay that up front. You would have the standard consultation that everyone has first, where we make sure you're in the right program, and then and only then, if you wanted to move forward, we would have you sign up for it. We are there to help you stay. Yep.
And Joe, regarding this program, when is the best time for someone to engage you in this process?
I always say the earlier the better, which seems like the stock answer, but I can tell you why. A huge part of the issue. So when people who go through this program themselves get rejected, I always say, it's not like you can just figure out what happened, fix it, and then apply again next week and expect the forgiveness. You have to wait a whole calendar year. So instead of 10 years for PSLF, now it's 11 years. And if you don't know where that issue popped up, you could have missed a payment or not consolidated something properly or not reported something in year 3. Suddenly you're going through 10 years of paperwork on just this data file that you get from the Fed Loan Servicing, which is the Department of Education, and you're looking for some discrepancy in there. So that's why we try to find the issues. That's why the auditing session first is us looking back at all of your qualified payments. And if we're starting from payment 0 or year 1, 2, or 3, it's a lot easier than going through from year 9 and looking to year 2 for a potential issue. So it's always better to get into the ground.
Yep, makes sense.
Of course. So yeah, the benefits there, to kind of piggyback off that, perfect segue, maximize the overall forgiveness event, unlimited access to our team of PSLF and IDR specialists. There's links to schedule a call to hop in whenever you need a meeting. You're up to date on any changes. Like I mentioned, that SAVE program wasn't available 6 months ago. Now it is, and that's going to be the optimum fit for a lot of people. So if you swap from one program to another, or one IDR from another, you're always going to be on the optimum repayment program for your specific situation. And then regular communication with the members via newsletters and members. Then finally, refinancing. Why would you want to refinance? You're losing eligibility for PSLF and IDR, and yeah, that's the case. But it's typically targeted towards individuals who want to aggressively pay off their student loans. Say you're working in a public health system right now, but you want to open a private practice, or you get an offer to join private practice. It's pretty lucrative. If you make that switch, you no longer have public service loan forgiveness available to you, because it is a program that's only available to people who work in public health system, public hospitals. So then you're in a situation where you should only refinance. Sure, you can switch to a private practice and stay in IDR, but keep in mind, then instead of 10 years, it's 20 years, and there's a tax hit. So refinancing allows you the opportunity to restructure your loan in a way that you can sometimes get a lower monthly payment by extending the term and overpaying. There's no prepayment penalty for overpaying. Or you just get yourself into a situation where you can log into a loan service and you say, okay, my payment's never going to change. I'm locked in at this. I have 8 more years or 5 more years, whatever the situation may be, and I know you're going to pay that loan off. And you can always refinance. But basically, the idea of why you want to refinance is you're getting set with a fixed loan. It's just a monthly payment with interest, and you know the term, and you're going to pay that thing off. You can lower your monthly payment and interest rates. You can pay off debt more quickly and efficiently, and reduce the number of loans. So how you're evaluated for refinance is fairly straightforward. The bank looks at your income, your debt to income ratio, which is just how much money you make in contrast to a debt that you have, your credit score, and then finally your savings. We are a broker. We have 11 different banks on our platform, and we try to match you up with a lender that's going to be the best fit for you. And we get paid through the banks we work with. Our refinancings come at no cost to So a quick case study before we wrap up. Borrower X is a recent graduate from medical school and is an incoming resident at a 501c3 hospital. Remember, 501c3, public health system. That means PSLF all day long. Her expected annual income is $70,000, and the residency is a 3-year program. And the borrower has $390,000 of both federal and private loans. Okay, so private loans, we already know those are not going to be included for PSLF, but we have the ability to address that in a moment. So $325,000 in federal direct loans ranging from 4 to 7.5% interest in a 10-year standard repayment plan with an estimated monthly payment of $5,200. $65,000 in private student loans spread over 6 different loans with an average of 9.75% interest and an estimated monthly payment of $935. What's the client's goal? Well, they want to pay that loan off within 10 years and lower their monthly payments. Solution: borrower is eligible for PSLF based on the qualified loan type and the employer. So you want to utilize the membership there for assistance and get the loans forgiven in 10 years, and then refinance the private loans to a lower interest rate and a more comfortable monthly payment obligation while creating savings for the future. So finally, just to put a pin on it, our consultation is our bread and butter. To get in contact with us, you would get in contact with Ben and his team. You have a meeting with them. They can connect you with someone on the GradFin team. And then from there, we have you upload your loan statements. You select the time to talk. Someone on Ben's team can be on the call if you like. And what we do from there is we take that half hour to carve out a repayment plan that makes the most sense for you. We compare refinancing versus public service loan forgiveness versus IDR. Get you in a situation where you're paying the least amount that's going to be working in your favor, creating savings for the future. The more we save, the more you can invest for your future. And basically, it's as educational as it is, looking into options, whether to educate you on the why and the how, not just provide you with the, hey, you should do this, hey, you should do that. We're actually going to take the time to break down what your loans mean and what those opportunities mean. And that's all I have. There's my
really helpful. Great, Joe. Really appreciate the time. I think this was a great overview, but really hard hitting on the specifics of what people need to be looking for, need to understand. I will say very quickly that it's very helpful to have a good personal cash flow statement. We found in working with physicians that a lot of times they don't have their own personal cash flow statement. So if you don't have that, come talk to us at DCA, and then we'll connect you with Joe to make sure that you get into the right program. I love their membership program. Really great idea to make sure that you're on the right track. But if you don't have a cash flow statement, you should probably get one, and we can help you put that together. Some questions, Joe. What are interest rates doing right now? What are you seeing as far as interest rates are concerned, and what are some strategies in order to get those interest rates down?
Yeah, so, slowly but surely, the interest rate environment is getting better. I mean, it was a pretty rough 2023 in terms of the average interest rate environment. I would say on average last year, you'd be lucky getting anything sub 6%. But as we're going into this year, we are actually forecasting rates to drop a little bit. Now, we are we have been, I should say, I'm over my words here. We have been pulling some 4% and 5%. Now, I'm not going to say that's going to be for everyone. Obviously, those are case by case situations, but we are expecting into the summer for rates to kind of regulate and get around 4 to 5%, which we were able to enjoy 2.5, 3 years during COVID. It's the only thing we probably could have enjoyed at the time, of really low monthly payments, 2% and 3%. Personally, I don't see that happening again in our lifetime, and I always try to manage expectations there, saying that 4 to 5%, that was the norm pre-COVID and was the norm for probably 10 years before that. So we're getting back to some normalcy on that side of things as
well. Okay, great. And another question came up. As far as if you already have private loans, is there any way to get back to the federal side in case you are eligible for forgiveness?
No. So private loans are going to stay private. From there, your options is to refinance. And I didn't mention it that much in the presentation, but one of the strategies for paying off private loans, because that is something that people ask about quite a bit, is basically you can structure your private loans to work in your favor. One of the huge things that I always say is you actually, when I connect with people and they say, I just want to pay this thing off, give me the shortest term possible, give me the 5-year. I'm like, okay, well, why don't we look at it like this? If you have a private student loan, sure, you can have the 5-year and you're going to pay it off in 5 years. Great. Why don't we look instead to an 8-year or even sometimes a 12-year loan? Yeah, the interest rate's going to be a little bit higher, but what the big catch is there, you're going to have a very low required monthly payment, and private loans have no prepayment penalty. So think of it this way.
Right.
Your monthly payment's very low, and you have some disposable income month over month. You can just aggressively throw at that and pay that thing off in much shorter amount of time. So that's just a consideration that we have.
Yeah, and I think that's a great point. We've seen that on our side as well. A lot of times, people are overwhelmed with the amount of student debt, so they think they want to get really aggressive, and yet it could be a little bit of a longer time period that's going to be helpful to them. So I really do think that's a great point. I think that's it for the Q&A. So again, just cleaning up at the end here, we do have another webinar scheduled for May. It's going to be on estate planning. Here's some information on our end. You can email us at info@dolanca.com. And our phone number is here again, dolanca.com. If you want to get in touch with us, we'll have both Joe's deck and this webinar available as a recording. Make sure that we get that out to all of you. So really appreciate your time today. We like to keep these to about 30 minutes, very hard hitting and packed full of knowledge. And we look forward to having you again in the future. So thanks so much, everyone, for joining, and we hope to see you again soon. Take care.